Welcome to the deep dive. Today we're not just crunching numbers, we're really looking at a high-stakes chess match playing out. Atlas Energy Solutions, ticker AESI, they just released their Q2 2025 results. And honestly, what we're seeing is a company playing some serious offense in what's frankly a brutal market right now.
Yeah, absolutely. They seem to be building this strategic moat,
Yeah.
and diversifying while a lot of their competitors are just, struggling to stay afloat.
Exactly. So we're going to unpack how they're doing it, what it means for them, and, why you should probably care.
It's a fascinating window, this earnings call. You really get a sense of how an energy services company is trying to navigate these pretty significant headwinds in the Permian Basin,
Right,
while also pushing forward with some really ambitious growth plans. It's quite a story of resilience, I think, and maybe some strategic foresight.
Okay, so let's dive straight into those numbers then. Q2. What did it actually tell us about Atlas's financial health?
Well, headline revenues came in at $288.7 million. And that actually beat the street estimates, which is, pretty noteworthy given the environment.
Beating estimates is good, but what else?
Yeah, but the company also posted a net loss, $5.6 million, which translates to a GAAP EPS loss that's, generally accepted accounting principles of 0.04 per share.
A loss. Okay. What about EBITDA?
Adjusted EBITDA, yeah. That came in at $70.5 million, so a 24.4% margin. But that was kind of at the lower end of their own guidance range.
Right. So a revenue beat, but a net loss, and EBITDA at the low end. A bit mixed.
Definitely mixed. But here's what's really fascinating, and I think critical for investors to understand. It's the resilience in their cash generation, even with that net loss.
Cash flow. Okay.
Exactly. They reported really strong cash flow from operations, $88.6 million, and adjusted free cash flow of $48.9 million.
Wow. Okay. That is strong.
It really is. It's not just like weathering the storm. It suggests a pretty solid operational discipline underneath it all. It lets them sustain the business and, crucially, sustain their quarterly dividend that's $1.25 per share, even when things look challenging on the surface.
So the market saw this.
Yeah.
How did it react initially?
Modestly positive, I'd say. But it really hinted at the complexity, right? You've got the revenue beat, the strong cash, but then the loss and this, challenging outlook.
Okay, let's definitely dig into that challenging outlook because we have to talk about the elephant in the room, right?
Yeah.
The Permian Basin.
Yep.
Management sounded pretty clear about a slowdown there.
Oh, indeed. Very clear. I mean, look at the frac crew count in the Permian.
The number of active crews.
Yeah. It dropped from around, say, 95 back in March to about 80 today.
80. And how significant is that drop?
Well, it's the lowest count we've seen since 2017 if you exclude the, the very specific COVID downturn period.
Wow. Lowest since 2017.
And here's the kicker. This drop in crews is actually amplified because frac efficiency has gone through the roof.
Ah, so each crew is doing way more work.
Exactly. The amount of sand pumped per fleet, per crew, effectively, has more than quadrupled since 2017.
Quadruple.
Yeah. And it's up maybe 25% just since 2023 alone. So think about it. It's like a construction crew building 4 or 5 houses in the time it used to take to build one.
Right. So you just don't need as many crews.
Precisely. And then you add in the pricing pressure. Spot prices for West Texas sand right now, they're sitting in the mid to high teens per ton.
Mid to high teens. Is that sustainable?
Well, management highlighted that level as just insufficient. It doesn't justify reinvestment for a large chunk of the industry.
So the takeaway is, this isn't just a temporary dip, it's more structural.
That seems to be the message, yes.
Yeah.
It feels like a structural shakeout is happening, favoring only the players who are super efficient and integrated.
You mentioned structural change. What does that actually look like on the ground? Are competitors really pulling back?
Absolutely. We're seeing reports, and management confirmed this, of competitors idling mines that aren't being fully used. They're reducing shifts. Basically, they're trying to cut costs because they can't make money at these current spot prices.
Oh, yeah.
And management actually expects 2025 might be the first year since this whole in-basin sand industry really started that the total supply capacity actually shrinks.
Contracts. Real?
Yeah. They estimate maybe 20% of the market's capacity could just come offline. It's like the market is purging the less efficient players.
Wow. So if 20% of capacity is potentially going away, how does Atlas fit into this? How do they not just survive, but actually thrive?
Well, this is where it gets really interesting, right? Because while competitors are idling mines and capacity is shrinking, Atlas is actually expanding its market share significantly.
Seriously? How is that even possible in this environment? That seems totally counterintuitive.
It does, but they are. Their share has ballooned from maybe 15% around their IPO to roughly 35% of all the sand sold in the Permian today.
35%. That's huge.
It's massive. And they think they can grab even more heading into 2026.
Okay, what's the secret sauce here?
It's not accidental, definitely strategic. It boils down to their differentiators. And the big one, the flagship, is the Dune Express.
Ah, yes, the Dune Express, the giant conveyor belt system. Been hearing a lot about that. What's the latest? And why do they call it a strategic unlock?
So the big news is it's fully operational now. And importantly, it was done on time. That's a huge win for a project this size.
On time is rare for big infrastructure.
Okay. And in Q2 alone, it moved over 1.5 million tons of proppant.
1.5 million tons just on the conveyor.
Just on the conveyor. And get this, by doing that, they estimate it took almost 8 million miles of sand truck traffic off the roads in the Delaware Basin.
8 million truck miles. Wow. That's incredible. Better for roads, less traffic.
Exactly. Huge efficiency gain. And that's why it's a strategic unlock. It drastically cuts the total delivered cost of sand for the operator.
Right. It's not just the sand price. It's the logistics cost getting it there.
Precisely. So the operator gets more reliable delivery and a fundamentally cheaper product right at the wellhead. Saves them a ton on logistics.
And is the demand there for it?
Seems like it. They've already contracted 5 million tons for 2026 delivery via the Dune Express, and they've identified another, 12 million tons of potential opportunities? So, yeah, strong demand signal.
Okay. And I heard something about multi-trailer operations.
Yeah, they're pushing that too, basically loading multiple trailers at once from the conveyor. For Atlas, that means even higher margins because it maximizes the efficiency of the whole system.
Got it. And then they added another piece recently, right? The PropFlow acquisition. Seems like another logistics play.
Correct. That closed late July. PropFlow adds on well site proppant filtration.
Filtration, so cleaning the sand right there.
Essentially, yeah. Cleaning and filtering it right at the well site, removing impurities. This does a couple of key things. It lets customers run their pumping operations 204/7 continuously. And crucially for safety and efficiency, it removes equipment and debris from what they call the red zone, that really high-risk area right where the action is happening at the well.
Better safety, continuous ops. Sounds like a win for the customer.
Big win. And for Atlas, it's a really logical bolt-on. It basically completes their whole mine-to-blender value chain.
Mine-to-blender.
Yeah, think about it. They dig the sand, they transport it efficiently with Dune Express, and now they filter it and deliver it continuously right where it needs to go at the well site.
Wow, end-to-end control.
Exactly. That's a powerful differentiator. It makes them much stickier, much more indispensable to their customers.
So taking a step back from the hardware and the tech, how's all this actually changing their relationships with customers? Are they moving beyond just selling sand?
Oh, definitely. Management was pretty clear on this. They see a distinct trend away from just, transactional spot market deals.
Correct.
Towards these fully integrated, often multi-pad contracts. They actually stated that about 60% of their active last mile crews now rely on Atlas for literally 100% of their sand.
60% get all their sand from Atlas.
Yep. That shows you it's not just about selling a commodity anymore. They're building these deep, really sticky relationships. It's based on reliability and that total delivered cost advantage, not just the price per ton you see on an invoice. Operators are essentially outsourcing their whole sand logistics headache to Atlas.
That implies a huge level of trust. A strategic partnership, really.
That's exactly the term I'd use, strategic partnership.
Okay, so that's sand and logistics. But earlier this year, they made that big move into power with the Moat Energy Systems acquisition. How is that diversification playing out? Especially now, with the Permian being tough.
Yeah, this is a really crucial piece of the puzzle, I think. Q2 was the first full quarter with more integrated. And management said the integration has actually gone better than expected. Surpassed expectations was the phrase used.
Good start then. And what kind of power projects are they looking at? Just oil and gas?
No, and that's the interesting part. It's much broader. They're actively evaluating over 200 megawatts of opportunities. And these span commercial, industrial, microgrids, and traditional production support for oil and gas. But get this. 60% of those opportunities are actually in that broader commercial and industrial space.
60% outside oil and gas?
Yes.
Why is that so important for them?
Well, connect it back to the bigger picture, right? It's about buffering themselves against the ups and downs, the inherent volatility of the oil and gas cycle.
Which we're seeing right now.
Exactly. The power segment is targeting significantly longer contracts. We're talking 10 years, sometimes more.
10 years plus. Wow.
Yeah. Those long-term deals provide really attractive, stable cash flows. It acts as a kind of counterbalance to the more cyclical sand business.
So it smooths things out. Are they actually deploying capital here yet?
They are. They expect to deploy about 40 to 50 megawatts of power capacity by the end of this year, and importantly, within their existing CapEx budget.
Okay, so tangible growth coming online soon from that new platform. That's definitely something to watch.
For sure. It signals real, non-cyclical growth.
All right, so looking ahead then, what did Atlas actually guide for Q3? What should we be expecting in the near term?
Okay, so for Q3, they do anticipate a sequential increase in volumes. They're projecting mid-single-digit growth there.
Volume growth, okay.
Yeah, they expect August and September to be their strongest months for volume. And the power segment should add a bit incrementally, too.
But I sense a but coming.
You sense correctly. But those volume gains are expected to be basically offset by lower average selling prices for proppant.
The pricing pressure again?
Yep. They forecast prices dropping to around $20.50 per ton on average. Yeah. That reflects that continued softness in the spot market we talked about. And there's also a reduction expected in shortfall payments. Those are the fees customers pay if they don't take the volumes they contracted for. That also hits revenue.
Got it. So volume up, price down.
Yeah.
What's the net effect on revenue and EBITDA?
The net effect, they expect, is a modest decline in consolidated revenue and adjusted EBITDA for Q3 compared to Q2.
Okay. So yeah, definitely a mixed bag for the near term. Volume growth is good, but it's getting eaten up by pricing. Seems like they're navigating immediate pressures while keeping that long-term strategy in focus.
Exactly. That's the sense I got. Management really hammered home the continued share gains and the strength of that logistics moat, especially Dune Express. They see those as key factors to defend their margins, even in this soft market.
And capital allocation, are they pulling back?
They reiterated a disciplined approach. They're investing in the logistics like PropFlow integration and the power platform. But, and this is key, they explicitly said they're avoiding new sand mine investments.
Smart. Don't add supply when the market's already saturated.
Precisely. Focus on maximizing returns from the integrated assets they already have, and all while keeping that dividend going. It's not just survival mode, it's strategic positioning for whenever the market does eventually turn.
Right. Okay. So for you, the investor listening, what's the kind of broader takeaway here, especially when you look at how Atlas stock has performed compared to the rest of the energy sector?
Yeah, that's important context. While Q2 showed, commendable revenue strength and that great cash generation, the guidance for Q3, that dip in EBITDA because of pricing, it clearly reflects those ongoing Permian challenges.
And the stock performance?
Well, if you connect it to the bigger picture, Atlas stock has actually significantly underperformed the broader energy sector, looking at the past 1, 3, even 12 months against something like the XLE Energy ETF.
Underperformed.
Yeah. And while the initial reaction to these Q2 earnings was, like we said, modestly positive, the shares have actually drifted lower into September. You see persistent headlines about the Permian Slowdown, and some analysts have trimmed their price targets.
So it feels like the market sentiment is maybe cautious, but maybe constructive. Like acknowledging the operational wins and the strategy, but still weighed down by the immediate macro picture and that underperformance.
I think that's a perfect way to put it. Cautious, constructive. Exactly.
Yeah.
The key things to watch now, the catalysts, will be the actual Q3 results when they come out. Also, any further milestones on Dune Express throughput, are they hitting those targets? How quickly is PropFlow being deployed and adopted? New contracts announced for the power segment, that'll be big. And then, of course, any signs of stabilization in Permian activity itself, or just broader oil prices, frankly. Those are the signals that will tell us if Atlas's offensive strategy is really winning out against these headwinds.
Got it. Okay, we've peeled back a lot of layers here on Atlas's strategy and the market they're in. Let's shift gears now. It's time for that segment where we have a bit of fun. Just a reminder, this is purely for informational and entertainment purposes only. Absolutely not financial advice. Think of it more like a maybe wild but plausible pitch you might hear bouncing around an investment committee. So after digging into this Atlas call, what's a trade idea that's been kind of cooking in your mind?
Okay, all right. Wild but plausible. Got it. Given everything we've talked about, here's a thesis for you. Go long Atlas Energy Solutions, AESI, and at the same time, short a basket of, let's say, less differentiated, maybe higher cost sand companies focused only on the Permian, or maybe some legacy oil field service names that don't have Atlas's integration.
Long Atlas, short the less differentiated peers. Okay, what's the rationale? Why that pair trade?
The rationale is simple. Atlas is playing a fundamentally different game. It's not just about selling sand anymore. That fully operational Dune Express, now combined with PropFlow for the last mile, that creates this honestly unparalleled integrated mine-to-blender logistics chain.
Right, that end-to-end control.
Exactly. It significantly lowers the total delivered cost for the operators and massively improves reliability. This isn't just like a small improvement. It feels like a structural advantage. Competitors just can't replicate that quickly or cheaply. It's kind of like, Amazon's fulfillment network versus smaller online retailers. It's not just about the product, it's the whole ecosystem. It's incredibly hard to compete against that on cost, speed, and reliability.
That's a powerful analogy, the logistics moat.
Precisely. And then you layer on top of that their power segment. It's growing fast, it's diversifying away from pure oil and gas, and it has those long duration contracts. That provides a non-cyclical growth engine, right? It insulates them somewhat from the oil and gas swings.
So the market might be missing this differentiation.
I think so. While the market seems to be pricing in, major Permian headwinds across the board, I believe Atlas's unique strategic position, that moat, will let them keep grabbing significant market share. They can consolidate power in the basin, and ultimately, I think they'll outperform those undifferentiated peers, even if the downturn lasts a while.
So it's a relative value play, not just a bet on the sector turning around.
Exactly. It's a bet on relative outperformance, maybe even eventual dominance in their niche. It's based on the conviction that Atlas is actively creating these new value propositions, and the broader market is kind of underappreciating it, just painting all energy service companies with the same gloomy brush right now.
Interesting thesis. Long the differentiated leader, short the pack.
Okay, well, that wraps up our deep dive into Atlas Energy Solutions Q2 2025 earnings call. We've definitely seen a company actively navigating a very tough environment using strategic acquisitions, big infrastructure plays like Dune Express, and a clear move towards diversification with power. Yeah, the key takeaway for me is really that commitment to integration, to innovation, all aimed at gaining share and building a much more resilient business model that can hopefully withstand these industry cycles better. Definitely keep an eye on those Dune Express adoption rates, how quickly customers sign up, and the expansion of that power segment. Those feel like the crucial indicators for their long-term success.
Absolutely. And remember, everyone, this discussion was purely for informational purposes. It is not financial advice. We really appreciate you joining us on the deep dive, and we'd love to hear your thoughts on Atlas Energy Solutions. Thanks for listening.